Is it better to be an active trader or a passive investor? That's what we're going to see in this video. I'm going to react to a study that tastytrade has done and in which they compared what is better between being an active trader or a passive investor. So without waiting, let's get into it.
Thomas, we're back, my friend. Even the S&P's down 550.
Unbelievable.
Bonds only up 8.
The whole thing is, we were so busy. I kind of missed selling S&Ps up there. I was too busy doing everything else. And I have to apologize. I did not buy that TLT position back for 252. I did the wrong trade, so I fixed it. It was kind of a scratch. Mm-hmm. So we had like whatever it was. I don't know, 17 winners and 1 scratch. Mm-hmm. But it was really interesting. The whole binary event thing, I mean, it worked out beautifully. We traded it, which is so cool because you can't play the information. There's nothing to play. Anyway, I got a great segment for you. I can't wait to do this today.
Bonds up 6 now. Unbelievable.
All over. We just sold 20 ticks higher.
Unbelievable.
And then if you're saying, well, why can't you just wait? I mean, it's not that easy.
At 31.25 a tick, yeah. You're not trading one contract here.
50 trades in the first 20 minutes a day. Crazy.
Yep.
Anyway,
and everything goes through Bob in real time.
This is, get your helmet on, Bat. Are you caught up?
I'm caught up. I'm
okay.
Good. Mm-hmm.
The guys wrote this up because we've had so much discussion on this recently, and I think it's so damn important. Active trading versus passive investing. So we often get questions on active trading strategies. Can they beat a traditional buy and hold strategy? Mm-hmm. So you know what? And I think we've proven our case, but there are still doubters out there. Like it's so funny. People will write to other people. They won't write to us, and they'll say, "Well, these guys are so full of crap." I'm like, man, I just wish they would spend. They still watch us, but they're still, but they're like. I wish they would spend 2 minutes just really looking at the numbers rather than always thinking, oh man, that is the way, because you read it in some book when you were in finance class, at some school. I don't care.
The problem, I think, in my opinion, with the trading industry in general is that there's so many players that are willing to just take your money without teaching you anything. There's just so much scam going on around. That it's the trading industry in itself is not necessarily a very trustworthy industry when you just look at it on YouTube and Google. I mean, 99%, let's not call it 99%, but a good chunk of the active players out there on YouTube and Google are just there to take your money. So it's completely fair, in my opinion, to be doubtful when it comes to active trading. That's why it's so important to rely on the numbers and try to look at studies. And I think that sometimes passive investing can beat active trading. For example, when it comes to very strong uptrends like we had in 2021, that's where passive investing can beat active trading. But it has been shown through options that if you trade options during more volatile times, like we are in at the beginning of 2022, then it's probably better to actually be actively trading rather than passively investing. It really depends on the context and what the market is currently doing. And of course, it's always hard. How do you know that the market is going to trend up over the next 6 months? Well, you never know what the market is going to do. But that's why I prefer to actively trade myself. I like to take advantage of, option premium, especially during volatile times like we are in right now. And even if I miss out on a few percentage points of returns during an uptrend, I'd still rather be actively trading.
Take a look at this. If this doesn't change your mind as to active versus passive, and I'm not talking about active like the stuff we did today. I'm just talking about just being involved, doing your fingers,
own thing.
Yeah, doing your own thing. Mm-hmm. Just
watching your own crap.
Yeah. Mm-hmm. So we went back to January of 2000. Now, if you're asking why do we pick January of 2000, it's because January of 2000 is our official start date from not being professional traders. Mm-hmm. That's the kind of the date. It could be any. You could pick a time, sure, but that's close enough. And that's essentially when we left the trading floor and came off the floor. So we want to learn too, and that's a good amount of data. Almost 15 years of data.
The good thing about those 15 years of data, I was actually wondering if they were including the 2008-2009 recession in that study. Apparently it does, because they said that it's over 15 years. And I believe that this has been recorded like in 2013, 2014, if I'm not mistaken. So that's good that they actually include some bear market also, so as to see how an active strategy is also behaving during a bear market. And maybe it's doing better than the passive investing one, which, puts the case of active trading in favor, because during bear markets, obviously everyone is losing money. So if you can find a way to be actively trading and not lose at least as much money as someone who's passively investing, well, I think it's worth it.
So I think this is very fair. In 50, a bull market in here, a meltdown, a bull market, everything.
Flash crashes, you name it was there.
So passive is just hold the S&P 500. Active is not even what we would call active. Active is kind of more of an old school definition of active. Active, strategy number 1, hold the S&P while selling a call. That's it. Strategy number 2, hold the S&P while selling a 1 month 2% out of the money call. So it's just a covered call or a 2% out of the money covered call. I'm considering those active. Or number 3, just hold treasury bonds while selling a put. Okay, that's it. The treasury bonds don't pay anything. So when I say active here, you can't argue and say, "Oh no, Tom,
I didn't have time."
None of your active strategies, this. It's selling one call. Wake up once a month. Don't get hit by a bus. Push one button and you're done. Okay, that's it. It's not even active in my mind, but it's the best we can do to the lowest common denominator.
Absolutely agree with them. I think those strategies that they mentioned, they're active, yes, because you actually actively sell options, but it's really the least active of the active trading world, if I may say. I mean, selling, for example, one option every single month, it's active because you're actually selling options, but it's not really active. It's not like if you were selling short strangles and managing your puts, managing your calls every single day. It's literally just pressing, as he said, one button once a month, and that's it. So active, there are different levels of being active in the market, and I'd say that those strategies that they mentioned is really the least active of them all.
Okay. So we did, first of all, then we graphed all these so you can see. And if you have trouble with the just with scale and everything else, don't worry about it now. It's just a picture to show you that we put it all in graphical format.
It comes real nice on the site.
Okay, beautiful. And you can see as you get into the the late stages of a bull market, okay, it gets interesting, right? But
that's super interesting to see this graph and to see how the different strategies are performing over time. What we can directly see, directly the thing that is the most shocking is how far is the put line. So you can see that is the blue line that is the first one on the chart, how it overperforms the other different strategies. And we can see that the black line, which is the holding the S&P 500, which is literally the passive thing that everyone does, we can see that, it's really lagging behind. And what's even more interesting, I think it's always interesting to look at how it's doing when it's going well, of course, but it's even more interesting to see how the strategy is doing during a bear market, for example, like 2008. And what we can see is that in 2008, all strategies would have lost money, okay? However, you can see that by selling a put, you would have less losses compared to the buy and hold strategies. First of all, because you would have made more money in the past. So obviously, you don't come back as low as the buy and hold strategies. But, you can see that your losses are way smaller than the buy and hold strategies. You have way less drawdowns. What's really interesting is that we can see by selling the 1 month out the money put, it's really this active strategy that performed the best. And honestly, as we said earlier, selling 1 month out the money put and every single month is not really active. It's really the least active of the active trading strategies. But we can see that during a bull market, the out the money put strategy overperformed the other strategies, meaning covered calls and buying and holding the S&P 500. And even during a bear market, as much as, yes, it lost money, it didn't do as much of a drawdown as the buy and hold strategies or the other ones. And after that, when the market started coming back up, we can see that the out the money put strategy literally, beat all the different active strategies and the S&P 500. One thing to notice though is that I said before that if there is a time where passive investing can beat active trading, it's during very strong bull markets. And if we look at the last part from 2013, let's say 2013-ish to the end of the graph, or even 2012, we can see that the buy and hold strategy has been going up. I think that it has performed better on a rate to rate basis compared to the at the money put strategy. We can see that the at the money put strategy, the blue line, is going up like, decent. It's decently going up, but the buy and hold strategy is really going up, I feel, faster from what we can see in the chart, which supports a bit, that thesis that during a very strong bull market, it might be better to passively invest, even though overall, we can see that if you had sold 1 month at the money puts every single time, you would be better off at the end. But we can imagine that if we had a very, very strong bull market continuing over and over, and we continue those trends, maybe at some point the passive investing would cross the returns of the selling 1 month at the money put. But of course, it never happens like this. That's why we have like 2020, crashes like in 2020, or we have, down moves like we had in 2022. That's where, for me, active trading is almost always better, except in very few cases.
But let's keep going. Let's throw some of the real numbers out there. The best performing strategy since 2000 was selling a cash secured put. Cash secured put.
It's like an IRA
That's
put,
no
right?
leverage.
Yeah.
It's a cash secured put. The best performing strategy. So now, to end all bullshit, this is, and also, by the way, we did all our own work here, and then we confirmed everything we did with all the statistics that are out from the SIBO and other exchanges that publish all their stuff and all the PhDs. We are spot on within like 1/100%, whatever it is. The best performing strategy since 2000 was selling a cash secured put.
Which is crazy, because just selling a, at the money cash secured put, is not really dangerous. As it says, it's cash secured. So if you sell a cash secured put, it means that you have enough money in your account so as to cover a potential assignment if you were to be assigned. So it's not even, as if you were selling a put on margin and you were actually using leverage so as to generate returns. Here, we're talking about a cash secured put. So you have the money to cover the assignment. The worst thing that could happen is, for example, if the S&P goes to zero and, now your 100 shares of the S&P are worth zero, but it's obviously, almost impossible. But because it's cash secured, for me, it makes the case even stronger, because, there is no discussion around potential leverage that you could use. It's all cash secured. So there is no leverage included here.
To be clear, cash secured put involves writing an at-the-money put in the S&P 500 while setting aside the money that would be used to buy the S&P 500 and put it in T-bills, overnight repos, money market. The T-bills are irrelevant, okay? So forget about it. It's a safety thing. So here are the results since 2000. Holding the S&P while selling, now again, we're going to go worst month. The worst month was 14.1%, which was selling a call against it, and that would have been 16.8% just holding the S&P outright. The best month, holding the S&P outright, obviously 15.7, and then we circled the highlighted ones here, and the percent of months with positive returns, the highest percent of months with positive returns was just selling puts. Now, before we get into anything like this, before we start getting all crazy and whatever else it is, if the average person who can figure out what a parlay bet pays at 13-5 and how to pay vigorish on a bet, whatever it is,
figure out what an under and over is.
We just had a 6-year bull market, and still the percent of months with positive returns is only 56%. So for everybody that thinks, okay, these markets aren't random, these markets are, I don't want to hear your bullshit anymore. I don't care. We're not listening. We appreciate it, but we're not listening.
What's really interesting about this table is, as much we had a 7-year, 8-year bull market, as he said, 56% of the month were actually positive, which is really, really odd because you could guess that way more months would be positive if we are in a bull market, but actually not. And that's very interesting to compare 56.4% in the last line to the selling put strategy, where we had 71.3% of the month that were positive, meaning that in the same market where we had a bull market, if you were selling puts, you would be right more often than if you were holding the S&P 500. And the reason is you're going to sell out the money put, so your break even is going to be lower than someone who would hold the S&P 500, hence why you have way more positive month than someone who would hold the S&P 500. And we can see now in terms of worst month, it's basically the same between 16.8% for holding the S&P 500 and 16.7% for selling an at the money put on the SPX. So basically you're having the same risk on, at least according to that study on this table, we have the same risk in terms of worst month. This is the worst for everyone, but your best month is a bit lower compared to holding the S&P 500, but you have way more months that are positive compared to holding the S&P 500. It's very, very intriguing to see the different results because I would expect, for example, my best month to be basically the same, but I didn't expect the S&P 500, buying and holding the S&P 500 strategy to have such a low percentage of positive month, meaning 56%. But that's very interesting to see those results.
There's absolutely no case that you can make if you're looking for months of positive returns that doesn't suggest that lowering basis outperforms. And the argument, which I've heard many people use, including many television commentators, well, why would you ever limit your upside, is absolutely ridiculous. It's false, it's ridiculous, it's untrue, if that's not the same as false for whatever reason, and it doesn't even hold water anymore. The whole case doesn't. But hold on, we're not done. Then what becomes interesting is, so we graph this out so you can see every single year. So you can see kind of the highlights, the lowlights. We color-coded it, graphed it out. So now you can take this to your friends. And when they say, hey, why are you doing this? I have this one guy who manages my money. He's unbelievable. He's made like 3% a year or 5% or whatever, 10% or lost 50%. I have no idea. And you want to know the reason why you don't John Bogle it and you're not buying an index fund? Because they suck too. Okay? Because they sucked. I'm sorry. They suck too.
I love this table because now we can see the yearly returns year per year. And what's so interesting is that, what I said before, when you're in a very strong bull market, that's probably where passively holding the S&P 500 might beat an active trading strategy like selling an at the money put. Well, we can see that, from 2009 to 2014, the buying and holding the S&P 500 strategy basically was doing better than selling the at the money put, the cash secured put on the SPX. You can see that, for example, in 2012, holding the S&P 500 made 17%, while selling the at the money put made 9% return. Then 2013, 28% versus 11%. We can see that when it's a strong bull market, we're actually doing better buying and holding the S&P 500. After that, there are a lot of factors that come in. I mean, here we were just selling a cash secured put. It's really the least active of being active, if I may say. But, just as a reference, it's good to know that during volatile times, that's probably where you want to trade options more actively. For example, the year 2002, those years, for example, where there was a bit more activity, that can be interesting to trade options because we can see 2000, you clearly beat the market by doing 12% against minus 11% for the holding the S&P 500. 2001 is basically the same. 2002, you beat again the S&P 500, etc., etc. You can see that it depends really on the year and what the market has been doing. But once again, it's really the least active of the active strategies. So if you're selling short strangles, managing all the time, etc., etc., I think the results can be completely different.
Okay, it doesn't make any sense. Everybody has to manage their own money. So here's those same very simple strategies. Everything's laid out. And again, we color-coded it, richest, worst, and then just so you can see every single year over the last 15 years. But we take it even further here. We're going to look at standard deviation is another term for risk, right?
Sure.
Okay, so let's look at the standard deviation, which basically suggests, because everybody's so focused on, well, I'm not selling that put, I'm not buying that future, I'm not doing whatever it is because of all the risk. The standard deviation of selling the 1 month put, okay, is 13%. Of holding the S&P is 18%. This will kill that entire discussion of, I don't sell puts. So your annual return is averages a percent better, but your standard deviation of risk is a third lower.
That's so interesting to see this. So what that means, to make it, maybe more simple, if we look at the last two lines, meaning selling the 1 month at the money put versus holding the S&P 500, on average, you make 1 point of percentage more by selling the at the money put. So you make more money on average compared to holding the S&P 500 on average. But the standard deviation, meaning the volatility in your P&Ls, how much is it going to move? How much volatility in your account you're going to have? We can see that you're going to have less volatility in your P&L if you sell in 1 month at the money put on the SPX. And remember, it's cash secured, so you take even less risk. But you make more money on average by selling a 1 month at the money put compared to holding the S&P 500. So that's really, really interesting. And personally, I've noticed this, that when I was holding stocks, I would tend to have a bigger volatility in my P&L compared to selling puts on different stocks. That's personally what I've noticed, so it's quite consistent with my experience. But it's crazy to see that if you sell a 1 month at the money put, not only you're going to make more money in your account, but also you're going to have less volatility in your account, which is, the best of both worlds in one here. So I'm not sure why no one would do this, but of course, if you want to have dividends, blah, 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 it's really, really useful. And also, as I said before, it really depends on when do you invest. If you invest in a very, very strong bull market, well, maybe holding the S&P 500 is better, but of course you never know what's coming. So that's always the difficulty of the market. In hindsight, it's always easy to be like, you should have actively traded there. You should have passively invested there. But how do you know that this period is going to come? How do you know that there's going to be volatility in the markets, 6 months from now, 1 year from now? No one knows. Or at least I believe that no one knows what the market is going to do. So it's always hard, and let's not be biased with the hindsight bias. It's always easy to know what to do in hindsight.
It's amazing. Hey, listen, the slides speak.
Explain, Juan Pablo. Explain.
He's okay.
Okay.
The slides speak for themselves. If you
explain, Juan Pablo, this is what I don't get. Why can't everybody have this just plastered on their wall so that when somebody comes in, they said, because here, if you want to manage my money, all right, you've got to show me something that's really special, that's going to make me think that you have a chance with a lower standard deviation, which is a measurement of risk, versus what my returns. First of all, 5.8%. Which is holding the S&Ps for the last 15 years, sucks anyway.
Okay, yeah,
Who
agreed.
cares? 5.8%? Really? Is that what we're in this for? Is that the home run after a 6-year bull market?
Is that what gets you out of bed, right?
That's right. Is that what's going to get you all fired up? Is a 5.8% return?
Yeah, I agree. 5.8, 6.8%, even 6.8% here. Remember that we're using really the least active of the active strategies. It's really low returns anyway. 5 points. If we make the argument what is better between the two, right now it's a bit, choosing between two things that both suck. It's true that 5.8% per year or 6.8% per year isn't much. But that's why, being active can also mean, if you sell, for example, a short strangle and you try to manage both sides, etc., maybe you can produce better returns than what is being shown here. And honestly, 5.8%, and you have a higher volatility in your P&L, you might as well try to sell a cash secured put and see how it goes and see if you prefer it compared to holding the stock. After that, maybe you want to have the dividends, which makes it compelling to actually hold the stock, hold the S&P 500. But, overall, I think it's really worth trying at least selling some puts on some stocks that you like, maybe doing some cash secured puts, maybe doing the wheel strategy. Maybe it's worth it so you can actually experience something else rather than holding the S&P 500.
15 years with 18% risk. I mean, come on. I mean, we'll look at sharp ratios and everything in a few minutes from now. But when you start to look at this and you start to look at I would much rather sell the 1 month at the money call on the SPX, have a 4.8% return with a standard deviation of 12, than a 5.8% return with a third more risk.
Yeah, I got it.
So what is the freak? I mean, why am I still arguing? Why are we still arguing this? And why hasn't everybody looked? This is all you got to do. Take this one chart, show it to everybody, and pass it around the whole world. That's it. It's done. Okay? Why do people
then
still?
Let's get back to work.
But why do people still listen to everybody? Why are we still listening to the I don't even know the other people. Otherwise, I wouldn't even say Bogle. I just don't even know who else we're talking about here. But why are we even listening? Their stuff is worthless. It's worthless. Even if that number was double. And so instead of 5.8, okay, it's
10%, whatever,
12%.
Mm-hmm.
Make it whatever. What is it? 11.6. Make it 11.6. Double that number. It still sucks. I don't do this for 11.6% a year.
Sure.
I mean, some years do we get 11.6%? No. Some years we would lose money, and then other years, you know what? You may make 60%.
Mm-hmm.
That's ridiculous. That's ridiculous.
Mm-hmm.
I mean, especially with inflation nowadays, we can see how we are being really killed on the inflation. Everyone is losing money day by day. So, and at least if you invest in the markets, I love this meme where it says that, before I used to lose like 5.8% with inflation. Now I'm losing 5.8% with inflation and 10% with the stock market. I found that meme very, very funny. But, the argument against active trading, let's be fair, is that obviously you pay commissions. Obviously, as you are active, you're not really there for holding the stock for the long term, even though, in the end, you make, in my opinion, better returns. But, there are arguments against active trading and especially commissions, even though commissions now are really low. But let's be fair toward both sides. Both have their pros and cons, of course. But active trading doesn't suit everyone. Not everyone wants to be actively mentally invested all the time in trading options, which I completely get. Second, actively trading means that you're going to pay commissions, so it's going to lower your returns. But hopefully you make enough returns so it still beats the S&P 500. But you get my point. So of course, like tastytrade is also a broker, so we need to be aware of this, that there is some bias here. But I still would tend to lean on the active trading side because I'm doing it myself, and I think it works way better than holding the S&P 500, especially in volatile times like we have right now.
This is a really cool little graph on the left-hand side of the page. It's annual returns over standard deviation. It's not supposed to look like this. All right, it is not supposed to look like this. Your standard you do not want your standard deviation of buy and hold to be all the way on the right-hand side of the page.
Right, that would be D.
That would be D.
Mm-hmm.
Yeah, ideally, you want to be the highest possible on the vertical scale, meaning that you have the highest return possible, and you want to be the closer to zero on the horizontal scale, which is the volatility of your P&L. So that's the standard deviation that they show. So ideally, you want to be, A for the standard deviation, which is like around 12%, but C in terms of returns. You want to have a mix of both. And when we see that D, which is holding the S&P 500, like not only has one of the lowest annual returns, but the biggest volatility. It's true that presented like this, we can really wonder why are we buying and holding the S&P 500 when we have one of the lowest returns. And also, you probably have noticed that I don't necessarily talk a lot about the covered call strategies, the two other strategies that they present. Because in my opinion, I cannot stand that strategy. I think it's a really, really annoying strategy in my opinion. I think I've probably done like once or twice covered calls, and really I just don't like it, honestly. It's not my thing. That's why I'm full on neglecting it right now. But, if that's something that you like, maybe you want to go for, selling covered calls against holding the S&P 500. If that's what you want to do, maybe, that's your thing.
Yes, you do not want that. Mm-hmm. And this is a great picture. And you can feel free to show this to whoever you'd like to. Taking this a step further, we graphed the whole thing out.
The team really did a great job on all
So in the market
stuff.
decrease of 2008 and 2009, holding the T-bill and selling a 1 month at-the-money put performed the best, even in that period of a meltdown. Although it's primarily because of the rise of treasuries.
Listen,
whatever.
I don't know what the hell Beef was talking about yesterday on the pitch, but this is an awesome market measure that we got here.
I hope that was interesting to see the different returns between passive investing and active trading. I hope it gave you some hindsight on how both behave, and I really think that honestly active trading has its usefulness when it comes to volatile markets, and also buying and holding the S&P 500 might better fit some people that do not want to have the mental investment of actively trading. I completely get it, but hopefully you find whatever suits you. Let me know if you have any questions down below. I'll be happy to answer any questions that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime I wish you all the best.